Plug Power's quarter is basically this. The stock screamed higher, and the company still spent the call explaining how it survives the cash burn.
Yeah, that's the whole movie. Not hydrogen is saved, more like, okay, the oxygen tank has a timer on it.
Perfectly bleak. You're listening to Earnings Unscripted, and today is May 11th, 2026, for posterity. We're looking at Plug Power, ticker Plug, and its Q1 2026 results.
And Plug, for anyone not living in hydrogen earnings land, sells fuel cells for things like warehouse forklifts, supplies hydrogen fuel, and builds electrolyzers, basically the machines that make green hydrogen.
The headline numbers are better, but not clean. Revenue was $163.5 million, up 22% year over year. Gross margin was still negative 13%, but that's a huge improvement from negative 55% last year. Operating loss narrowed to $109.5 million.
Tiny legal speed bump before we get too spicy. This is not financial advice, just our personal opinions with caffeine and caveats included.
Thank you, counsel. EPS was negative 18 cents on GAAP. Adjusted EPS was negative 8 cents. We don't have a clean sequential income comparison or consensus estimate in the material, so, no pretending there. But the market did not seem bothered.
Not even slightly. The stock came into earnings trading at $3.12, then ripped higher during the regular session and stayed elevated after hours, finishing more than 20% above the prior close, which is very Plug Power because that stock rally also helped trigger roughly $140 million of non-cash accounting charges tied to convertibles and warrants.
Wait. The better the stock does, the worse cap income looks?
In this case, yes. It's not operational failure. It's the liability revaluation doing its little accounting goblin dance in the basement.
I hate how useful that image is. But operationally, there were real improvements, right? Electrolyzers were the star?
Absolutely. Electrolyzer revenue was up 343% year over year, helped by big European projects like Iberdrola and Gulp. Service costs also came down more than 30% per unit because the fuel cell stacks are lasting longer. That is boring engineering, but it matters. Fewer broken parts, fewer technicians on site, better economics.
And then there's the very human, very weird demand story. Plug is now selling hydrogen forklifts partly because data centers are eating the electric grid?
Exactly. The CEO said a warehouse with about 200 electric forklifts can need around 2 megawatts of grid power. If the local utility is already overwhelmed by AI data centers, hydrogen starts looking less like a green trophy and more like, please let my warehouse keep running.
That's such a strange 2026 sentence. Forklifts, AI, grid bottlenecks, hydrogen. Put it all in a blender.
But the blender still needs cash. Unrestricted cash fell to $223 million, and operating cash burn was about $150 million in the quarter. So the real story is not the revenue print, it's whether they can close that asset monetization pipeline, especially the first Stream Data Centers deal expected in June.
So first impression, the quarter is not. Plug is fixed. It's more the company is finally acting like the build-out phase is over. CapEx dropped to roughly $8 million, and now Jose Luis Crespo has to prove the assets can actually produce cash.
Yes. New CEO, lower CapEx, better margins, stronger electrolyzer demand, but still a very serious liquidity clock. That's the tension. The market loved the direction. Now the numbers have to catch up.
All right, let's get into the details because that cash pile is doing a lot less comforting than it looks.
Yeah, because the cash pile has two personalities. On the slide, it looks like $800 million. In real life, the usable part is closer to $223 million, and the rest is largely restricted cash sitting behind older obligations.
So it's cash with a little velvet rope around it. Very glamorous, very unhelpful.
Exactly. And this is why I think the deep story is not hydrogen demand. It's balance sheet surgery. Plug is trying to turn trapped capital into usable oxygen before the operating business can stand on its own.
Okay, but how do they actually untrap it? Because restricted cash always sounds like money in a glass case that says, break only in emergency.
In this case, some of it is tied to legacy power purchase agreements and operating lease liabilities. The CFO said, quote, "We made strategic buyouts of certain operating lease liabilities associated with our legacy PPA business, and that this serves as a means to accelerate the release of restricted cash reserves."
So they're paying to get their own money back.
More or less, which sounds absurd, but it can be rational if the old contracts are choking the company. It's like paying off a bad roommate so they finally move out.
Hydrogen finance, sponsored by awkward lease breakups.
But that's the texture here. New CEO, new discipline, less empire building. They sold the SK Plug Hyver stake at the end of last year. Hyvia went into judicial liquidation, and the big DOE loan guarantee effort was suspended while they try to reframe it. Those are not growth at any cost signals.
That's a pretty sharp change, right? From we're building the hydrogen future to please hand me the scissors, we need to cut things.
Yes, and management basically said that out loud. Paul Middleton said, quote, "Our hydrogen production network is built. We are now in a leverage the asset base phase. The CapEx run rates reflects that." That sentence is doing a lot of work.
Because CapEx went from a symbol of ambition to a symbol of restraint.
Right. But restraint alone does not save you. CapEx being only around $8 million this quarter is helpful, sure. The bigger issue is operating cash burn. They used about $150 million in operating cash in Q1. So the stream data center's monetization, especially that first $142 million expected in June, is not some side quest.
It's load-bearing.
Very load-bearing. If it closes on time, the bridge gets stronger. If it slips, the market has to reprice the risk pretty quickly. I'm not saying it will slip. I'm saying that timing matters more than the press release tone makes it sound.
And then they're also trying to pull, over $100 million out of inventory by year end?
Yes, and that's another underappreciated lever. Inventory reduction can create cash without requiring a miracle sales boom. But no, let me say that better. It creates cash once. It does not prove the core economics are fixed.
That distinction matters, because you can clean the kitchen and still not know how to cook dinner.
Exactly. The real proof is gross margin. And there, I'll give them credit. Fuel margins improved dramatically because of better third-party gas sourcing and logistics. Service costs are down more than 30% per unit because the stacks are lasting longer. That's not marketing fluff. If a fuel cell stack lasts twice or 3 times as long, you stop sending so many people into the field to replace parts.
That's the unglamorous turnaround. Fewer truck rolls, fewer technicians parked at customer sites, fewer things breaking at 3 a.m.
Yes, this is the first time in a while where some of Plug's improvement story sounds operational instead of purely aspirational. It's physical. Better stack life, better sourcing, better logistics. The machine is becoming less expensive to keep alive.
But still not profitable.
Still not profitable. Negative gross margin is still negative gross margin. Improved losses are not profits wearing a hat.
It's brutal, but fair.
And hydrogen is the exciting piece, but they're also lumpy. Big projects in Europe can make growth look explosive, then timing can move around. Management said the first half should be about 40% of full-year sales, which means the back half has to carry a lot of the year.
So investors are being asked to believe a sequence. Asset sale closes, inventory comes down, margins keep improving, big projects land, and by Q4, they get to that positive EBITDA run rate target.
That's it. It's not one heroic event. It's 5 practical things happening in the right order. Less cinematic, more stressful.
And maybe more credible because it's practical.
Maybe. I like the operational fixes. I'm cautious on the liquidity path. Both can be true. This quarter says Plug is behaving more like a company under adult supervision. It does not yet prove the adults have enough time.
So as we zoom out, the question is less, is hydrogen back? And more, can Plug execute this sequence before the clock gets loud again?
Exactly. And I think the market is giving them a narrow conditional pass. Like, okay, we see the discipline now, but the pass expires fast if June cash does not show up.
Yeah, because this is not a vibes turnaround. It's a choreography turnaround. One misstep and suddenly everyone remembers the balance sheet again.
Right. Management is guiding for a sequential revenue and gross margin improvement in Q2, full-year sales growth of 13 to 15%, and a back-half loaded year. The CFO said the first
first half should be around 40% of full-year sales. So the second half has to do real work.
Which makes next quarter less about one heroic number and more about trust. Do they show cleaner cash usage? Do margins keep inching towards zero and beyond? Does inventory actually come down?
And do they avoid another emergency financing feel? That's the investor psychology here. The stock rally helps sentiment, but it also raises the bar. You cannot tell people positive EBITDA run rate in Q4 and then wobble through Q2.
I do think there's a more hopeful read, though. The company finally sounds less like it's chasing the hydrogen future with a megaphone and more like it's managing a factory, a fleet, a warehouse. Actual stuff that breaks.
That's fair. And the demand story has gotten more practical. Grid constraints, data center pressure, synthetic aviation fuel. Those are not just climate PowerPoint themes anymore. They're operational headaches for customers.
So the outlook is cautiously constructive, but with a giant asterisk wearing a hard hat.
Yes. Plug is not fixed, but for the first time in a while, you can see what fixed would have to look like.
All right, that feels like the right place to land. Hopeful, but not hypnotized.
Good standard for hydrogen stocks. And life, probably.
We'll leave it there for Plug Power. Thanks for listening, everyone. If you'd like these earnings drops to just show up when a new quarter lands, following the show is probably the easiest little habit cue. And quick transparency note, this episode was made with AI-assisted research, writing, and voices with the figures coming from the company release and earnings call transcript. If you've got feedback or a ticker you want us to tackle, send it to earningsunscripted@datamadness.ca. Take care, and we'll see you on the next call.